Sandip Agarwal, fund manager, Sowilo Investment managers, joining us on the show. Girish Pai, research analyst, head of institutional equity research at BOB Capital Markets, joining in. Gentlemen, a very good morning to you. We're looking forward to this conversation because, the lack of clarity is what is worrying as far as IT stocks are concerned. Sandip, you pivoted recently, where you were very negative IT, and then the last few conversations we had, you said that valuations changed the story. Are you still sticking by that stand?
Yeah, hi, good morning, and thanks for having me on the show. So, Tamanna, I will take 1 minute and I will explain you what is happening. So, if you go and see the hardware cycle, right, almost 20 years, there has been no substantial growth in hardware cycle before AI kicked in. So, last 2-3 years, you have seen substantial spend on hardware, and hardware cycle comes in for 3-4 years. It is a hockey stick growth, mad growth, and then you go in hibernation because whatever hardware you bought, basically it is like buying a house. You have bought the house now, and then you have to build the furniture. That means you will put that operating system platforms and the sales platforms, which the big seven in the US are doing. So I think that Google, Microsoft will be very, very big winners of this, and they will see a sustainable good growth of the low double digit for a longer period of 4-5 years. That goes without saying. I think this hardware and GPU, we are in the last leg, maybe another 12, 16, 18 months. There could be some sale, and then you will see a very sharp dip, which should come in my view, followed by good growth continuing with these platform companies, which are able to sell what they are building with this hardware. So you have to remember that hardware is for building the product, that is the software or the platform product. And these companies which are building the hardware and software products, they will have a longer growth, but lower growth, not like 100% growth of NVIDIA and AMD. Then comes the third, which is the service provider or the outsourcer. So we will come into action once the product and the platform players make the product which they have already made. You see the revenues of Anthropic and all other. Now that will need servicing. So see, I was very, very negative 14 months back because, as Girish said, I think that minimum 30% effort cut is there. So we were in an industry which was matured in the US market, growing at 4-5%, and then you have 30% cut. So no way you can have 5-6 peg ratio, 40 times multiple and all that. And I was very clear that 50% index level cut has to happen. And I think broadly we are there, 35-40% cut has happened. But now you have to also put into this thing that 18 to 24 months of this has happened. So hardware sales are broadly behind. We are in last stage. Product platform are broadly built. You will need servicing of them and rectifying them and providing services on that. And now, the index has corrected 40-50%. At the index level, stocks have corrected even more. And more importantly, we have currency which has depreciated 15-16%. Now, the counter argument everyone on the channel is coming and giving is that last 10-12 years, none of these IT companies are showing the benefit of currency, which is grossly wrong, because you have to also remember after 2014, after new president came in, he enforced that you have to have localization. So we have 22% local resources, which has now moved to 75. They have taken away all the currency benefits, but there is no incremental cost from here. So I believe lower growth for longer, next 5-6 years, but very high PAT growth is the story of the industry.
Okay.
That's all from my side.
Girish, do you concur that there could be very high PAT growth? I mean, there is a CEO who recently wrote that what Anthropic did was effectively kind of putting to validation the requirement for software services, whether Anthropic does it or some others do it. Right? Get Sandip on that argument, because Sandip, Girish makes one very valid point. The rupee having depreciated so much so swiftly, from here on, the case for a rupee depreciation, a swift rupee depreciation may not be there. Is there a case for a very high margin expansion, and why so, for you to believe that the profit growth will be strong?
No, so what we have to look at is, for example, what is your net foreign exchange which you receive annually, and if you do that math, means I have done that and we have in Excel, the amount are surprising. Means I can tell you no one today is predicting those numbers. You just put the number what net foreign exchange in different currency these companies get a year, and let me tell you, the easiest way to look at, another way to look at it will be that you divide the EBIT margin of each of these companies by 100, and you will see the sensitivity towards EPS. Let me tell you, I have done some sensitivity. In my view, most of the companies will have 15 to 45-50% EPS delta just because of currency, forget growth. So even if we go by, let's say 5-6% growth, I don't see any reason why EPS will not be more than 60-70% in next 3 years from current level. Means it is not possible mathematically. So if you have more than 70% EPS growth from here in next 3 years, why will stock remain here unless they further derate by 60-70% in terms of multiple, which then they will become a bad case than NTPC in my view, which is very unlikely.
Underweight the sector. Sandip, what is the investment theory or the investment decision?
So see, we run a PMS. I will not give you name, but I will tell you what not to buy. So I will say that stay away from ER&D companies because they are super expensive, and I don't think you will make money in them. They will grow better than IT services. But any traditional IT services, this after 24 months into the disruption, and I'm all talking about cycles. You see, last 25 years cycle, I have seen 7 cycles in that. Every time after 24 months of disruption, big rebound comes in growth, but always comes in the software services. So I will stay away from ER&D. I will stay away from everything which is 1.5 or 2 times PEG ratio. I will stay with anything which is less than 1.5 PEG ratio because that will give me easily 30, 40, 50% return in next 1 year, 1.5 years. That is what my view is. And I believe that at some point of time the analysts will redo their numbers, and when they do redo their numbers, they will concur with my view. Either you say that this company should trade at 50% discount to NTPC multiple, or you say that there is a big return to be made. It cannot be none of this.
Valid point. Well, at some point of time, maybe we'll try and do is there a moment which brings in, ushers in newer kind of IT companies? They may not be IT service companies, but IT companies out of India. Would be interesting to see that.
I propose a redux of this conversation 6 months down the line from Sandip and Girish. I'm going to take your time now itself, and then let's see what happens. We'll do this every 6 months and see where it's going. How about that? I think we need to track the story more closely with these two views. So that's the bull versus bear case on IT. Very interesting discussion, Neeraj, because absolutely polarized views and reflecting what's happening with the index. So for viewers, you need to pick a side right now if you want to make an investment with conviction, or if you find it too confusing, just stay away.
Yeah.